3 months ago, a woman named Patricia walked into a mortgage lender's office with a credit score of 621. The loan officer delivered the news she expected. She would qualify for a mortgage, but the interest rate would be brutal, nearly 7% on a 30-year loan. On a $350,000 home, that rate would cost her over $180,000 more in interest compared to someone with excellent credit. Patricia asked if she could have 90 days to improve her score before locking in the rate. The loan officer smiled politely and said sure, but warned her not to expect miracles. Credit scores move slowly. A few months would not change much. 93 days later, Patricia returned. Her credit score was 761. The loan officer actually asked if she had submitted the wrong Social Security number. She had not. Patricia had simply learned about a mechanism built into the credit scoring system that most consumers never discover. A mechanism that banks and credit card companies understand perfectly, but have zero incentive to explain. That 140-point jump saved Patricia over $215,000 in lifetime interest on her mortgage. Same house, same income, same person, different knowledge. What Patricia discovered was not a hack or a scheme. It was not disputing accurate information or exploiting technical glitches. It was a legitimate feature of how credit scores are calculated, hiding in plain sight, that the financial industry profits from keeping obscure. Today, I am going to show you exactly what Patricia learned. By the end of this video, you will understand why everything you have been told about building credit slowly over time is technically true, but practically misleading. There is a faster path that the system allows, but nobody advertises it. Let me start by explaining why the conventional advice about credit scores keeps people trapped longer than necessary. The standard guidance says pay your bills on time, keep your balances low, do not open too many new accounts, and wait. Wait years. Wait decades. Let your credit history age like fine wine. Eventually, your score will climb into excellent territory. This advice is not wrong, it's just incomplete, in a way that benefits lenders enormously. Every month you spend in the fair or good categories rather than excellent costs you real money. Higher interest rates on credit cards, worse terms on auto loans, steeper mortgage rates, higher insurance premiums in many states, larger security deposits in apartments. The credit score tax falls heaviest on the people who can least afford it, and the slow conventional path keeps them paying that tax for years longer than necessary. Banks profit from this extended timeline. Someone with a 680 score who could have a 780 score is a more profitable customer. They pay higher rates, they generate more interest revenue. The bank has no incentive to help them escape that category quickly. The secret Patricia discovered involves something called authorized user trade lines. Understanding how they work requires understanding how credit scores are actually calculated. Your credit score is essentially a statistical prediction of how likely you are to default on a debt within the next 24 months. The algorithm examines your credit history and compares your patterns to millions of other consumers. The single largest factor is payment history. Have you paid your bills on time? This accounts for roughly 35% of your score. The second largest factor is credit utilization. How much of your available credit are you currently using? This accounts for roughly 30%. The third largest factor is the length of your credit history. This includes the age of your oldest account, the age of your newest account, and the average age of all accounts. This factor accounts for roughly 15% of your score. Most people assume length of credit history is simply a function of time. You opened your first card at 18, you are now 30, you have 12 years of history. Nothing to be done about it. Just wait. But that assumption is wrong, and the error is exactly where the opportunity exists. When you become an authorized user on someone else's credit card account, that account's entire history appears on your credit report. The account's age, payment history, credit limit, and utilization all get imported to your profile as if you had been part of that account from the beginning. Read that again because the implications are significant. If your mother has a credit card she opened 23 years ago with perfect payment history and low utilization, and she adds you as an authorized user today, that 23-year-old account appears on your credit report immediately. Your average account age could jump from 2 years to 12 years overnight. Your total available credit could double or triple. Your longest account history could extend by decades. This is exactly what Patricia did. Her mother had 3 credit cards with a combined age of over 40 years, perfect payment history, and utilization under 5%. Patricia became an authorized user on all 3 accounts. Within 2 billing cycles, those accounts appeared on her credit reports. Her thin credit file suddenly looked robust. Her short history suddenly looked established. Her score jumped 140 points. The authorized user strategy is not a secret to people in the credit industry. Mortgage brokers know about it, credit repair companies know about it, banks definitely know about it. But it is rarely advertised to consumers because there is no profit in shortening the time people spend in high-interest territory. Let me share another example that shows how this works across different circumstances. Marcus was 24 years old with a credit score of 589. He had made mistakes in college, missed a few payments, and maxed out a store card during a rough semester. He was trying to finance a used car, and every dealer quoted him interest rates above 14%. His grandfather had credit cards dating back to 1987, spotless history, combined limits over $60,000, utilization consistently under 3%. His grandfather added Marcus as an authorized user on his 2 oldest cards. He never gave Marcus a physical card or access to the accounts. The addition was purely strategic. Within 60 days, Marcus's credit report showed accounts with 37 years of perfect payment history. His average account age went from 2 years to nearly 19 years. His available credit tripled. His score jumped to 697. That crossed the threshold that qualified him for auto financing at 6% instead of 14%. On a $25,000 car loan over 5 years, that difference saved Marcus nearly $5,200 in interest. His grandfather's simple action, taking about 10 minutes online, transferred decades of credit worthiness instantly. Now, let me walk through exactly how to execute this strategy, because the details matter. First, the account you are added to must be in good standing. Perfect payment history is ideal. Any missed payments will hurt rather than help. Utilization should be low, ideally under 10%. The account should be old, with older being better. Second, the primary account holder must be willing to add you. This typically means family members or very close friends. Many people add authorized users without ever giving them a physical card. The addition is purely for credit-building purposes. Third, not all issuers report authorized user accounts to all 3 credit bureaus. American Express, Chase, Bank of America, Capital One, and Discover generally report authorized users. Some smaller banks and credit unions do not. Verify reporting practices before executing the strategy. Fourth, the impact appears within 1 to 2 billing cycles after being added. You do not need to wait months or years. The history imports almost immediately once the issuer reports the account to the bureaus. Fifth, you can be removed as an authorized user at any time, and the account will eventually fall off your report. This makes the strategy low risk for the primary account holder. If circumstances change, they can simply remove you. Let me expand beyond authorized users to other mechanisms the credit system contains that most consumers never fully use. The second mechanism involves understanding exactly when credit utilization is measured and reported. Your utilization ratio, the percentage of available credit you are using, accounts for roughly 30% of your score. The conventional wisdom says keep it under 30%. More sophisticated advice says keep it under 10%. The actual optimal target is between 1 and 3%. But here is what most people do not realize. Utilization is calculated based on the balance reported to credit bureaus, which typically happens on your statement closing date, not your payment due date. You might pay your credit card in full every month, never pay interest, use your cards responsibly. But if you are charging $2,000 per month on a card with a $3,000 limit, and that balance appears on your statement, you are showing 67% utilization. Your score is being penalized even though you pay in full. The fix is simple. Pay down your balance before the statement closing date, not just before the due date. If you reduce your balance to $50 before the statement closes, you will show less than 2% utilization when reported to bureaus. Your score could jump 20 to 40 points almost immediately, simply by changing the timing of your payments. The third mechanism involves credit limit increases and their surprisingly large impact. Utilization is a ratio. You can improve it by reducing your balances or by increasing your limits. Most people focus exclusively on balances. The limit side of the equation gets ignored. Many credit card issuers offer credit limit increases with no hard inquiry on your credit report. American Express is particularly known for this. You can request an increase through their app or website, and they will often approve significant increases using a soft pull that does not affect your score. If you are carrying $2,000 on a $5,000 limit at 40% utilization, getting that limit raised to $10,000 drops you to 20% utilization with no change in behavior. Your score improves simply because the math changed. Request increases from all your cards every 6 to 12 months. Each increase improves your utilization ratio. Over a few years, someone starting with $10,000 in total limits might accumulate $50,000 or more simply by asking periodically. Banks rarely advertise that you can request limit increases. They certainly do not encourage it. Because higher limits mean customers have lower utilization and better scores, which leads to those customers qualifying for better rates elsewhere. The fourth mechanism involves something called rapid rescoring, which most consumers do not know exists. When you're in the middle of a mortgage application, time matters. Improving your score through normal channels takes 1 to 2 billing cycles. Rapid rescoring can update your score within days. Your mortgage lender can request that credit bureaus immediately update specific items on your report based on documentation you provide. Pay off a credit card balance and provide proof. The updated zero balance can be reflected within 72 hours rather than waiting for the next billing cycle. Rapid rescoring is not available directly to consumers. You can only access it through a lender during an active mortgage application. But knowing it exists lets you time your credit optimization appropriately. The combination of strategies executed with rapid rescoring can produce score jumps of 50 to 80 points during the application process itself. Let me give you a clear action plan based on where you are right now. If your credit score is below 650, the authorized user strategy offers the largest potential impact. Identify family members with old accounts, excellent payment history, and high limits. Request to be added as an authorized user on 1 to 3 accounts. Simultaneously, pay down any credit card balances to below 10% of limits before your next statement closes. If your score is between 650 and 720, you are in the optimization zone, where multiple small improvements can create significant gains. Request credit limit increases on all existing cards. Adjust payment timing to reduce reported utilization. Consider the authorized user strategy if you have a thin file or short account history. If your score is above 720, you are likely fine for most purposes, but optimization still matters for the best mortgage rates. The difference between 750 and 780 translates to meaningfully different interest rate offers over the life of a loan. Regardless of starting point, pull your free credit reports from all 3 bureaus annually and review them for errors. Studies consistently show that a meaningful percentage of credit reports contain errors, some significant enough to affect scores and loan eligibility. Disputing legitimate errors should happen alongside everything else I have described. Now, let me tell you the deeper truth underneath all of these tactics. The credit scoring system was not designed with your best interests at the center. It was designed to serve lenders, to help them predict risk and price their products accordingly. Every month you spend in a lower score category is revenue for someone else. The bank that charges you 7% instead of 5% on your mortgage earns the difference every single month for 30 years. Patricia did not game the system. She learned how the system actually works and used its own rules to her advantage. The same rules that have always been available. The same rules the industry has always understood. She simply found out what they were before the lender needed her not to know. That $215,000 she saved, that was not found money. It was always her money. The system was simply counting on her not knowing how to keep it. You now know how to keep it. The next time you sit across from a loan officer, a car dealer, a landlord, or anyone who pulls your credit, you are not at the mercy of a number you do not understand. You understand the number. You know what built it. You know what can change it. And you know that the timeline they told you was necessary was never the only timeline available. My name is Angela, and I will see you in the next one.